right now we are smack in the middle of a perfect economic storm. And in this storm, two totally opposing investment philosophies are clashing head-on. You've got the futurist, who's betting it all on a tech revolution, and then you've got the skeptic, who's warning that this is all just a massive bubble built on some seriously shaky ground. Okay, let's dive right into this massive investor's dilemma. So here's the game plan. First, we're going to set the scene with this economic storm brewing for 2026. Then we'll jump into the ring for the big debates, the AI revolution, what's really going on with big tech, and of course, where you should even think about putting your money right now. And don't worry, we'll wrap it all up with a practical survival guide to help you navigate all this chaos. So what exactly is this storm we're talking about? Well, it's this convergence of risks, all hitting at once, creating an economic environment that has policymakers completely paralyzed and investors, frankly, terrified. Let's peel back the layers and look at the numbers that are really telling the story here. First up, the price of oil. We're looking at West Texas Intermediate crude, and it has absolutely skyrocketed to $113 a barrel, a direct result of the war in Iran. And let's be really clear here, oil isn't just another line item. It's the literal lifeblood of our economy, and right now it's fueling the fires of inflation across the board. And this is where the story starts to get really concerning. A loss of 92,000 jobs in February. Now, this isn't just a blip on the radar. This is the third straight month of job losses in the last 5. This is the stagnation part of our problem, a huge flashing red light that the economy is actually contracting. So where are people running? Well, look at this. Gold is trading at over $5,000 an ounce. You know, when you see a classic safe haven asset like gold pushing its all-time highs, it's not a good sign. It tells you there is some profound, deep-seated anxiety about the value of paper money and the stability of the entire system. You put all of that together, and you get this one ugly word: stagflation. It's a total economic nightmare because it creates a policy trap. You see, the cure for one problem just makes the other one worse. If the Fed raises interest rates to fight inflation, they're going to kill even more jobs. But if they cut rates to try and save jobs, they risk sending us into hyperinflation. So what do? There's just no clean exit. You know, we've actually seen this movie before. Back in the 1970s, you had an oil shock, you had soaring inflation. Back then, the Fed chair, Paul Volcker, did the unthinkable. He raised rates to a crushing 20% to finally break the cycle. But here's the kicker for 2026. What's different this time? Oh, just one little thing. 36 times trillion dollars in national debt. The interest payments alone are on track to be bigger than the entire defense budget. A Volcker-style move today doesn't just risk a recession, it risks a full-blown sovereign debt crisis. It makes the Fed's job infinitely harder. And all of this brings us to round 1 of our big debate. Because right in the middle of this crisis, the biggest companies on the planet are making this unprecedented, all-in bet on artificial intelligence. In one corner, the futurist sees a revolution. And in the other, the skeptic sees a bubble that's just about to pop. Let's start with the futurist case. And their argument starts with this really, really big number: $611 billion. That's the projected capital expenditure, or CapEx, on AI for 2026 alone. Now, for the futurists, this isn't just spending. It is a mission-critical investment in the single most important technology of our lifetime. And here's how the futurists justify that spending with this analysis from Goldman Sachs. What they're saying is, look, the potential return is just staggering. They're pegging the present value of future income created by AI at $8 trillion. So from that perspective, $611 billion isn't expense, it's just a down payment on the entire future of the economy. But wait, the skeptic fires right back, pointing to what they call the monetization gap. We're spending over $600 billion a year on this stuff, but so far, AI is only bringing in about $20 billion in actual revenue. That's a 1-to-1 gap. The skeptic is screaming, where is the return on this massive, massive investment? And the skeptic is quick to warn us that we've all seen this movie before. Remember the late 90s? Telecom companies spent $500 billion laying all this fiber optic cable, convinced the internet was going to need it all. Well, their projections were way, way too optimistic, and it led to a historic collapse. The skeptic's big question is this AI boom just another dot-com bust in the making? This whole debate over AI spending leads us directly into round 2, where we have to look at the companies at the very heart of this boom, the Magnificent Seven. So, Are they the pillars holding up our economy, or are they a house of cards just waiting for a breeze to knock them over? So here, the skeptic introduces a really important concern, this idea of circular investing. The theory is that the Magnificent Seven are all basically just propping each other up. Think about it. Microsoft buys NVIDIA's chips, which fuels NVIDIA's revenue. Then NVIDIA uses that money to buy cloud services for Microsoft. It's this self-reinforcing loop that can look like incredible growth from the outside, but it might be dangerously fragile. Okay, so let's break this down and see how stagflation could stress each of these companies differently. You've got NVIDIA, the infrastructure provider. They are highly sensitive to any slowdown in that $600 billion capex spending. Then there's Meta, which is totally dependent on ad revenue, and we'd all know that's one of the first things to get slashed in a recession. Now, Microsoft and Amazon, they seem a bit more resilient because of their strong enterprise cash flows, but let's be real, they are by no means immune to the pressure. So this all leads us to round three. I mean, given the stagflationary mess and the structural risks we're seeing in big tech, the debate shifts from just analysis to action. The skeptic is asking, if tech is so risky, then where on earth should your capital go to survive and protect your purchasing power? So here's the skeptic's playbook in a nutshell, a great rotation out of growth tech and into real assets. See, high-growth tech stocks get absolutely crushed when interest rates go up. Why? Because their value is based on profits way out in the distant future, and higher rates make those future dollars worth a lot less today. But real assets, think domestic energy producers, think gold, things that own scarce physical resources, those have historically been the biggest winners during periods of high inflation.
You know, this isn't some new idea. Back in the last great stagflation, Warren Buffett himself warned that inflation is like a gigantic corporate tapeworm. It just invisibly eats away at the real value of a business's earnings. This is the core principle, the very foundation of the skeptic's argument for reallocating capital.
And Buffett basically gave us the playbook for finding companies that can survive this tapeworm. He looked for two things. First, something called pricing power. So businesses that can raise their prices to pass on rising costs without losing all their customers. And second, low capital intensity. Companies that don't need to spend billions and billions just to stay in the game. This is the value investor's North Star in a stagflationary storm. So, who wins this debate, the futurist or the skeptic? You know, our goal here isn't to declare a winner. It's to give you a framework, a set of questions, to help you decide for yourself as we enter this totally new economic world. All right, here it is, your survival guide. Ask yourself these 5 questions about every single one of your investments. Number 1, is this company an AI capex spender, or is it a direct beneficiary of all that spending? 2, how much debt are they carrying, and can their free cash flow, the actual cash they have left over, cover it? 3, is there a clear, believable path from all their spending to actual revenue? 4, how are you balancing the future's exciting growth story with the skeptic's cautious value approach? And finally, 5, what happens to this company if interest rates have to stay higher for longer? We'll leave you with this one final thought. What we're going through isn't just another market cycle. It's the great convergence of inflation, stagnation, and unbelievable technological disruption. You know, the last decade was all about low inflation and 0% interest rates. It was the perfect environment for growth tech. The next decade might be defined by scarcity, by inflation, and by a much higher cost of capital. So the most important question you can ask yourself is this: is your portfolio built for the world we just left behind, or for the one we are now entering?